Hi, everybody. Griffin Cooper here from Ablewaytech, and I wanted to do a little case study on what Dr. Ken Long has termed the morning hook. And I want to kind of do it from a hybrid perspective here, looking at some multiple time frames, different indicators to kind of see what we can see in a lot of different lenses. But let's start out with the the 3-minute charts, and we can see here this what the morning hook is. Right? We had this big gap, big sell-off, and then the turnaround here with the SSC, that then was a very nice trade. Couple things I notice. This is definitely a GC3 setup. Um, there's at least 2 to 1. What's interesting here is that this red line is the low of day from yesterday. So there's a really nice kind of failed test here of the low of day from yesterday, which I think adds a bit of an edge there. If we move on and look at the 15-minute, we see here there was the move up and then what basically formed a Kata 2. If we put, actually, I put some Fibonacci retracement levels on this. This was exactly a 38.2 stock kind of retracement level. Well, one of the Fibonacci recurring retracements that will happen after a move up and a pullback. If we look then, and that was a 15-minute, if we then multiply that by 5 to another factor, we get to about a 74, 75-minute chart, which we can see was clearly trending up. Right here was where this morning hook happened, and we can see that it actually came down to test the PSAR, which is interesting. And then if we then go out to the daily, well, the daily was certainly trending up as well. Another way we can look, which is kind of interesting, is to see it as well through, where are we here? Yes, if we look at it just in terms of some support, dynamic support from moving averages, one thing I've noticed often is that on the 15 minutes with K2s and SSCs, we get a big test of the 50. The 50 is the red here. And then last night I just, for the heck of it, said, well, what if I go out to another Fibonacci level and add the 89? Because the punches through on the 50 of the 15 are really pronounced. They don't usually touch it. They go way past it. So I actually just said, well, what if I just went out to the next Fibonacci level of 89 and look right there how it hit. I mean, that kind of hit me right between the eyes. So we'll see if that's maybe a recurring, that it comes down to test that 89 period moving average. That could be something we'll use in the future as well. If we look over, there we go. If we look at it on the on the 74, it was interesting because we actually get dynamic support of the 21 here, which is pretty obvious and nice to see. Hat tip to Gabriel there. And as well, we can see, just like on the Kata challenge layout, the trends in the higher time frame. So just kind of some initial exploratory research here on Dr. Ken Long's morning hooks. And I like looking here. This one was on DIA. If we go back to our 3-minute chart here, this was on DIA, which I think is interesting because I've been thinking and looking at the academic research that, for stocks, 50% of the movement is from the broader market and 25% is from the sector. Well, that gives maybe the possibility that, the large equity indexes and the more uncorrelated ETFs, if you will, the patterns might be more reliable as opposed to a pattern, let's say, on an individual stock might be also then beholden to the pattern on the equity index itself in the sector. So I don't know if that's true, but it's something that I think is interesting, and I'm going to start researching, these the large equity indexes, as well as maybe some other kind of commodity ETFs, metals, things like that, to see if the patterns might be a little bit more reliable in that fashion. So anyway, I hope that was interesting, and thanks for watching.